Thanks, Dave. Hello, everyone, and thank you for joining us in the first of our series of events on the road to COP26. I'm Robert Begbie, Chief Executive of NatWest Markets and your host for today. I don't need to explain to anyone joining today that tackling climate change is not just important, but an imperative for the livelihood of our society and the planet, or the fundamental role that the financial industry plays to accelerate and enable the significant shift required to achieve net zero. And climate is a key pillar of NatWest's purpose. And in the markets business, we are focused on building greater capability and awareness around climate and ESG for our customers and colleagues. And later this year, we have COP26, for which NatWest is a principal partner and is a key milestone which many expect to cement greater ambitions and targets for global leaders around climate. Today, we will focus on the role of investors, and I'm joined by a fantastic panel from across the investor community. All are well-renowned experts in their respective fields, and all have been instrumental in driving industry change to tackle the climate challenge. Firstly, I'd like to welcome Jane Ambacher, Global Head of Sustainability at BNP Paribas Asset Management. Jane was consultant to the UN through the development for the Principles for Responsible Investment and is a trustee of the Carbon Disclosure Project, a member of the Financial Stability Board Task Force on Climate-Related Financial Disclosures, and a member of PRI Academic Working Group. Welcome, Jane. Secondly, David Blood, co-founder and senior partner of Generation Investment Management. David worked with Al Gore to co-found Generation Investment Management, which since its founding in 2004 has played an integral role in the development of sustainable investing, and is a regular speaker at the World Economic Forum and considered one of the pioneers of sustainable investing. David spent 18 years at Goldman Sachs, including serving as CEO of Goldman Sachs Asset Management. Welcome, David. And Steve Waygood, Chief Responsible Investment Officer for Aviva Investors. Steve leads the Global Responsible Investment Team, which is responsible for integrating ESG issues across all asset classes and regions of the circa 350 billion of assets under management. Steve is a member of the European Commission High-Level Expert Group on Sustainable Finance and the UK Green Finance Task Force, and is also a member of the Finance Stability Board Task Force on climate-related financial disclosures. And lastly, my colleague, our moderator for today, James Close, who is our head of climate at NatWest. James has spent his career working at the interface of the public and private sector, as is now committed to working on some of the most challenging global issues, focusing on sustainable development and climate change. He's a member of the Energy and Natural Resources Advisory Group for the ICAEU, and was previously the head of Circular Economy Programme for London and the Director for Climate Change at the World Bank. So without further delay, I will pass over to James to begin our discussion. James.
Great, thank you very much, Robert, and good afternoon, everybody, and welcome to our guests here today. We've got a great panel for a really lively discussion, and hope to get through to some questions from you in the audience as well. But let me start off with a question to all of you, if I may. Given your respective positions at some of the world's leading asset managers, how have you mobilized your organization to embrace sustainability into the investment decisions that you've made? And what are some of the unexpected outcomes that you've experienced in doing that? Now, I'm going to start, if I may, with you, Jane, please.
Sure. Well, thanks. It's a pleasure to be here today and part of this discussion. In 2019, we launched our global sustainability strategy, and really the objective is to put sustainability at the core of everything that we do as an asset manager. And so we developed a really structured approach. We have 6 specific pillars of activity, and I'll just touch on each really quickly and then give you my surprising fact, pleasantly surprising fact in this case. The first commitment is around ESG integration, which we've really, we cover more than 12,000 entities in our research, and we have a structured way to integrate ESG into all of our different investment decisions. Our second pillar is around stewardship, how we vote, how we engage with companies, and also with policymakers. Our third approach is around what we don't invest in. So our responsible business conduct expectations around topics like tobacco, coal, unconventional oil and gas, which leads to a list of exclusions. Our fourth pillar is around kind of embracing our role as a future maker and thinking about how we can use our influence to tilt the economy towards a more sustainable path on three topics, which we've prioritized: the energy transition, environmental sustainability, and equality and inclusive growth. So those four pillars are integrated across our different investment platforms, across the different asset classes. In addition, the fifth pillar is what we call our Sustainable Plus range. These are about a third of our total AUM that do something more. They may be thematic funds focused on climate. They might be impact investments. That part of our business is growing 4 times faster than the rest of our business, which is a huge reflection of client interest in really allocating capital towards solutions. And the last pillar is what we call kind of walking the talk, our own CSR approach, where we focus on our own internal diversity targets. We look at our zero waste target and a focus on reducing absolute emissions. So it's really kind of quite a comprehensive approach. Now, my interesting or surprising statistic is that we recently reached out to our staff as one of our regular kind of take the pulse surveys. And one of the things we asked them was, tell us, we listed a number of different statements on different topics. And one was around, being a sustainable asset manager. And the statement was, it's important to me that we become a fully sustainable asset management firm. And they could agree, they could be neutral, or they could disagree. 94% of our colleagues said it's important to them that we become a fully sustainable asset management firm. So I think that's a great reflection of how far we've come in terms of really embedding sustainability into our approach, and the fact that it's also important to our colleagues in terms of their own day-to-day work.
Oh, that's extraordinary, Jane. What a great statistic. 94% agreeing with that statement. And Steve, if I could ask the same question to you in terms of mobilizing your organization to embrace sustainability.
Thank you, James. And thank you to NatWest Markets also for the invitation to be here. It's a real privilege. Thank you. I really enjoyed the beginning video that you played, and I just absolutely emphasize what was said about this being the biggest challenge facing society, even despite the massive challenges that we've all been undergoing over the last year. Climate change still remains the world's biggest challenge for us to deal with this generation, and we have perhaps only 8 to 10 years to do that, and we all have a role to play. So just to undergird the key points that were made in that video, absolutely right. In terms of how we mobilized Aviva, I'd say there was probably 3 things that really mattered. Aviva, back in 1995, well before I joined in 2006, Aviva had already recognized that climate change was a risk to its business and had signed various public declarations to that end. So it wasn't that the kind of science was under question at all. I think the thing that really helped motivate was clients, and not just their own expressions of interest. Fantastic statistic there from Jane, but also the financial returns analysis around what would happen to the long-term performance of their funds, the absolute performance, particularly over the coming decades. It will be harmed by the climate crisis unless we deal with that. So there was that fiduciary duty to clients, and we're getting a bit legal here, but the fiduciary duty that we have to clients' long-term interests, that's obviously got to guide us. And then as a listed business, it's a fiduciary duty that we have also, as our board has, in fact, to the shareholders. And those aren't just today's shareholders. Legally, it has to be future members too. And as an insurance company, as I work for the fund manager for an insurance company, we need to think about what happens to flood risk, fire, crop damage. And I mean, it's not the thing that most people should be first concerned about. It's civilization, actually, and how that will be tested. But from a shareholder fiduciary perspective, it is absolutely clear that the insurance sector are the canaries in the coal mine on this one. And that's why Aviva back in 95 was saying what it was saying. Swiss Re and Munich Re are also, as reinsurance businesses, have also been in the vanguard. So first things are to make the financial case to the customers, and then the fiduciary case, the legal case to shareholders. and then one needs to mobilize. And you asked as well about this unexpected outcome. There's been a lot of better data that we have from an investment perspective, pricing securities more solidly, if you like, from the looking at the exploiting the market inefficiency, if I can use the jargon, to enhance long-term risk-adjusted returns. But the unintended outcome is when you look at sovereign debt, the countries that are most exposed to physical climate risk tend to also be the least developed and most in need of capital. And when you start to integrate climate risk into the low-lying island states, their cost of capital is only going in one direction, and it's already hard enough for them to secure capital to invest in adaptation and mitigation. So there's a great alignment of integration in many areas, but there's one area, particularly sovereign, where as you integrate climate risk, you can lead to very bad, further unintended outcomes for development and poverty. I think we need to have a just transition mindset, and that's perhaps my greatest concern just there. Back to you.
Great. No, thank you very much, Stephen. I love that idea of the insurance industry being the canary in the coal mine here. And David, you've been a real pioneer, trailblazer. Perhaps you could...
Okay. Good afternoon, everyone. Well, I have to confess, Generation has it much easier than Aviva and BNP or NatWest for that matter, because we were established with the purpose of integrating sustainability and ESG into our investment process 17 years ago. And people often ask me, well, why didn't you, if you were the CEO of Goldman Sachs Asset Management, why didn't you just go ahead and do it then at Goldman Sachs? And the answer is it's very difficult. So the work that Steve and Jane and James are doing is really very, very difficult work. But the point is that the progress that's been made over the course of the last nearly 2 decades is pretty extraordinary. But we established Generation because we felt that the investment framework, which I'll briefly describe, would be best practice. We believed then, and certainly do now, that long-term investing is best practice, that sustainability is a current and future driver of economies, sustainability broadly defined to include the environment, to include climate change, to include poverty, to include racial justice, to include a just transition, as Steve noted, to include health, obviously, pandemics and water challenges. These are issues that are increasingly relevant to economies and interlinked and must be factored into understanding industries and businesses. And lastly, we believed that environmental, social, and governance factors were tools to help us understand what a company does and how a company does it. Ultimately, these 3 pillars we felt would be a framework, an investment framework, to deliver superior investment results, risk-adjusted investment results for our clients. We've never thought about sustainability or ESG as trading values for value. And what has surprised us most over these last 17 years is the mission component of our firm. So when we established our firm, we felt we wanted to accomplish 2 things. One is to deliver outstanding investment results for clients, and secondly, to promote sustainability and ESG in the capital markets. And what we've discovered is that mission, we're a B Corp, this mission orientation has allowed us to attract and retain some extraordinary people, has allowed us to attract some extraordinary entrepreneurs into our private investing business, and indeed has allowed us to work with some of the most extraordinary CEOs and finance directors in the global capital markets, because our philosophy is interesting and has become much more interesting over the course of the last 3 to 5 years. And so what's powerful about the business model that is reinforced by mission is that it allows you to be more robust in how you approach your investment philosophy and ultimately the deployment of capital.
Great. And I really love that phrase. We're not trading values for value, David. And in that context, within Generation Investment, you believe in the transformative power of allocating capital to businesses that deliver positive and productive change. And how have you been able to measure this impact? putting a value on your values, I suppose.
Well, so it's a great question, James, and it's one that increasingly will be asked of all of us. But the first point we want to make, of course, is that all investing has impact. All business has impact. And we mustn't forget that the impact of generation, the impact of NatWest markets, et cetera, are quite profound and quite relevant. And we think eventually, in fact, we think probably eventually defined in the next sort of 5 years, when we report to our clients, we will be, our clients will insist that we report on the old basis, of course, risk and return, but increasingly impact. So we believe that impact will be a critical measure of performance as we go forward. We already perform or report on our impact, both from an environmental perspective, as well as a social perspective and governance perspective. I would say at best, we would give ourselves a C- in terms of the quality of our reporting to date. But we believe that we will have to be closer to B/A over the course of the next couple of years. And both Steve, Jane, and I have been working on the TCFD. We think that that's an important component of it. SASB is important. The impact measurement project that is being led by Clara Barbie is important. All of these initiatives are critical because ultimately capital allocation is about risk, return, and impact.
I think that's a great point, David. And we've learned that ourselves from our own climate disclosures report and also our ESG report, Our Purpose in Action. And it is a game in which we will get better as we play more of it. And Jane, in your role of establishing the UN principles for responsible investment, which in many ways are the kind of foundations for a lot of what we're talking about here, how do you see industry bodies, like UNPRI, the net zero asset owners, and the role that they can play to accelerate change in this sort of constantly increasing ambition? And how have these organizations influenced BNP's asset management investment decisions and your operating model?
Great, thanks. I mean, it's fun to think back to the days when we were, so I was with Mercer at the time as a consultant working with the UN to help set up the PRI. And I remember fondly, the first meeting we held, which was, 30 CEOs from pension funds around the world, and a few of us from Mercer and of course from the UN, kind of crowded into these windowless basement rooms at the UN headquarters in New York. And, 2 days of talking about what could this set of principles look like? And trying to get, the North Americans and their lawyers to agree with, the Scandinavian funds who were, a little more aspirational in some of their objectives. And amazingly, we ended up with this set of principles that people could kind of get their head around. And, I went and checked this morning. There's over 3,000 signatories now with more than 100 trillion in AUM. So absolutely, it kind of stuck. And I think that the PRI, was very timely because we had such little consistency in terms of what does sustainable investing even mean, right? And it was this principle that, well, look, we need to have better information so we can make better decisions, and we need to behave responsibly as owners through voting and engaging and asking other people to, disclose what they're doing. And then we should report on our progress, right? And it's kind of this virtuous circle, which has carried on. I think that, the role of collaborative initiatives and frameworks is incredibly important to help to bring clarity, to drive transparency, commonality. I do think that we are now in a stage where there are so many initiatives, we can risk the law of diminishing returns at times where, people just, what acronym are you talking about? Wait, TNFD or AIGCC or TCFD? So, there are a lot of frameworks. And one of the things that we're very focused on is encouraging more collaboration, right? So I think the investor agenda is very helpful, where you've got the 7 kind of core, groups, the PRI, UNFFI, the different regional investor groups on climate, and CDP, who kind of tried to build a house around the different climate related initiatives, which I think is great. The new asset owner the asset owner and the asset manager net zero commitments sit within the investor agenda, as does Climate Action 100 Plus, which, in my opinion, I think is one of the most critical frameworks for pushing companies who haven't necessarily, haven't yet committed to be net zero or to get on that pathway, who have a whole lot of pressure from, their largest investors to accelerate that transition and to try to bring solutions, right? We're trying to help facilitate the transition in a way which will be both effective and profitable, right? So I think that's really about finding solutions together. So absolutely, we are, very, very focused on working in collaboration through many of these initiatives. Yet we also are quite cautious in terms of what we will commit to, and don't want to just end up spending all of our time reporting on what we're doing to all of these different frameworks, and make sure we leave enough time for, the actual getting the job done.
Yeah, great. And I think we all feel the same way, Jane, around all of that. It is how do we drive change within our organizations? And Steve, from your point of view in Aviva, an asset and investment firm, and I mean, you really sort of reflected it in terms of this asset and liability matching. There's no point being a pensioner in 30 years' time and finding that you can't enjoy your livelihood because the places you want to visit are now underwater. You've set a target to be net zero by 2040, which is ahead of the 2050 target that's often quoted in the Paris Agreement. How did you arrive at that target, and what do you think is the biggest challenge in delivering it?
I was listening to Jane avidly. I remember the meetings that she's referring to. They were fun, and they really felt like we were pioneering. They may have had no windows, but they had a lot of vision, I think. And it was, I remember, I think it was Jane actually who brought in the very first sentence to the PRI. If you read the principles, the very first sentence says, to the extent consistent with our fiduciary duties, we commit to the following. And then the principles kick in. And that fiduciary duty commitment, I mean, it gets reinterpreted and reinterpreted periodically within the US. It gets a lot of political risk within it, but it does, that political risk makes it quite hard to set long-term targets. But it is interesting that it has been 16, 17 years since we wrote those principles. And they probably need to be updated, because this sort of proliferation of different initiatives is partly because the underlying principles themselves don't actually have a framework, a full framework for recognizing the SDPs and net zero and so on. So perhaps it is time to revisit the Global Compact, the Sustainable Stock Exchange Initiative, the Principles for Responsible Investment, the Principles for Sustainable Insurance, and so on, and make sure net zero is more embedded in them, not just allowing this proliferation of other initiatives. So our targets, 2040 net zero, there are two others that matter as well. 2030, 60% reduction, 2025, 25% reduction. We have 350 billion under management. And so the scope 1, 2, and 3 levels that it applies to, so our own energy generation, our supply chains energy generation, and then every other impact from all of our portfolios, that's all in scope. And we set that through, and as I said at the beginning, when your first question came, we had to go through a process of recognizing how important it was to the strategy, then informing and training not just the board, but also the executive about how we would govern such a commitment, recognizing what the science says, what would be the best that we could do. And we kept, Amanda Blanc is our new group chief executive, and our constant refrain was ambition, ambition, because of the scale of the problem. And we shouldn't let the lack of full understanding of exactly how we will deliver everything stand in the way of delivering what we know needs to happen. So we've set 2040, I think, very ambitious. For those of us that understand the science, some people would say that 1.5 degrees by 2050 is itself unconscionable, but we can't allow that mindset to prevail. If people do start from that perspective, then we'll definitely not deliver. So 2040 is our target. It is incredibly ambitious. And I think probably the biggest difficulty in achieving it is going to be having sufficient number of securities from the government world. that we can own. But sovereign debt is a significant part, one of our biggest asset classes. And knowing at what point a sovereign is 2040, is net zero is a big challenge. And I'm smiling now because I remember Jane's colleague, Mark Lewis, at the last TCFD plenary making a very similar point brilliantly. And that just goes back to the power of collaboration. So this panel with David and Jane on it, it's fantastic. It shows we've already been collaborating as a panel for the best part of the last 2 decades. We can dream about what the next 2 decades have in store. Maybe we will get to net zero by 2040, but we've got to give it a shot.
Yeah, I mean, I think that's just a really powerful point, Steve. And we were talking to Penny Endersby, the Chief Executive of the Met Office, and she reminded us of the danger of overshooting 1.5 degrees and how challenging it is to get back from there, and also the high risk of some extraordinary tipping points in the world's climate system. And we're already seeing some of those come into visibility. And I think it's really interesting that both you, all three of you, talk about this on the risk side, but also on the opportunity side, because we're going to make this enormous shift in the global economy. And the question for all of you really is, what are the key enablers, whether it's policy, whether it's tax, whether it's carbon pricing, are going to make the biggest difference in mobilizing that capital towards net zero? And, perhaps when you're reflecting on that, you could also tell us some of your greatest concerns around that trajectory and what we can do to mitigate it. And I'll start with you, David, if I may, on that question.
I think we have to start with our own houses, if you will. Let's be sure that we're all committed to net zero and we have actions to achieve them. And Steve has made some extraordinarily important points around the challenges of committing to and achieving net zero. Generation is in a much more, frankly, beneficial position because we're smaller and we're very concentrated on either public equity or private equity. So we don't have some of the same challenges that Aviva or BNP have. But the first thing to understand is what does your portfolio tell you? So you have to assess your risks, assess where you are on your commitment to net zero. You need to ensure that as you understand it, you need to engage with the businesses to help you achieve the net zero. Of course, capital allocation, and I suspect we'll talk more about that, we think is a critical step in becoming net zero. And we've all talked about a collaboration. So for us, it's reporting and alignment, it's engagement, it's capital allocation, and it's collaboration, these 4 tools. And on balance, we are actually quite optimistic about the asset owner and the asset manager world. And we believe that the banks and insurance businesses will also align to net zero. That's certainly Governor Carney's ambition. There's no question about that as we head into COP26. I think the real challenge that we're going to have to start to wrestle with, and it's really hard, is that to make this transition, we're going to need to move between $2 to $3 trillion per year over the course of the next 30 years. Right now, we are allocating about $200 billion. So the amount of money that we need to move, including into emerging markets, is pretty extraordinary. So we're going to have to think differently about what capital allocation looks like. We're going to have to think differently about risk and return and length and tenor, if you will. And we're going to have to think differently around the importance of transition assets in your commitment to achieving net zero. So what we worry is that this is hard. We have no choice but to be focused on it, but we're going to need to fundamentally transform, not incremental, but transform how we think about investing and how we think about business and capital allocation over the course of the next 5 to 10 years. And I think we've all talked about the urgency of the crisis. This isn't, if you think back, Steve and Jane were talking about the beginnings of the PRI. We've made so much progress in these 17 years. It's really extraordinary, truly extraordinary. But if we only make the same amount of progress in the next 17 years as we have in the last 17 years, which was extraordinary, we won't make it. We won't even be close. we're going to have to be 5x, 10x of the progress we've made over the course of the last 10 to 15 years. So the challenge is huge, but we have to do it, and we can do it. We fundamentally can do it.
Great. I mean, really powerful points, I think, David. And Jane, what's your view of the enablers? What else do you need that's going to help you get to that 5x, 10x pace of change that David's talking about?
Sure. When we think about, our own kind of aggregate assets, it's pretty simple, right? We're trying to move away from the brown, right? So we've got a pretty stringent coal policy, focus on unconventional oil and gas, big focus on topics like deforestation, moving more into the green, right? So we've, launching more and more strategies that are trying to allocate to solution providers, both on the fundamental side, but also on the systematic side, Paris-aligned benchmarks, et cetera. So, I mean, from an overall position, it's move out of brown into green and then engage with those companies in the middle to transition. So the more that we can have a supportive, public policy environment to really accelerate that, the better. So it's fantastic to see now that, well over half of global GDP is in, countries and jurisdictions which have committed to net zero. What we need to see and what we need to see this year at COP is the NDCs that really back that up and show us, okay, well, how are we going to get there? Like, let's make that a reality. So one of the things that we're actually getting more involved with is the inevitable policy response work from the Principles for Responsible Investment. So what this is really a forecast policy scenario, right? What is the most likely basket of scenarios that we'll see unfold over the coming 5 years, 10 years to transition, not just the energy sector, but every sector of the economy, and moving away from kind of a concept of scenario analysis where, we might hit any temperature. Let's try to understand what that might feel like, to no, we know where we need to go. Let's forecast the policy pathway that will take us there. And I think one of the next big opportunities and obligation really for us collectively as investors is to coordinate our engagement around the effective implementation and acceleration of those policy changes. In the same way we're coordinating engagement with big companies, big emitters on Climate Action 100+, we need to have coordinated country-led engagement, by investors with the G20, Climate Action 20+. So to me, that's really one of the most important opportunities that will not only help us to better understand the transition, but it will allow us to accelerate the implementation. So I think that's a huge opportunity. Just in terms of concerns, I mean, just a couple of things to flag. One is there's this new paper in Nature that talks about the Amazon rainforest at the risk of now becoming a net emitter instead of a net carbon sink. I mean, this is, of course, terrifying and an issue that we all, I think, need to focus on in an accelerated fashion. I mean, the other thing that concerns me a little bit is, there's so much interest in portfolio level kind of temperature metrics, which of course is really is easy to understand. I mean, kind of it resonates with investors when they can look at a portfolio and get a temperature. So of course that's attractive, but we also know that there's a lot of methodological kind of development still to be done, and you can have 12 different methodologies and 12 different temperatures for the same portfolio, which isn't very helpful, right? So I guess we're a little bit torn from that top down, we all need to steer the ship in the right direction versus the kind of bottom up, how granular and specific do we really think it's appropriate to be? So to me, that's one of the kind of interesting debates that I think we'll see play out over the next kind of year as more people dig into that kind of metric. And it's something, of course, we've discussed and debated a lot at the TCFD.
Yeah, great. I mean, I think, Steve, you talked about the sovereign challenge here, and Jane's mentioned NDCs. And obviously, we've got the UK green gilts being produced. Italy's just announced that they're going to be doing one as well. Now, how do you see that in terms of driving your portfolio and as an enabler for you at Aviva to address this challenge and to hit your targets?
I'm very supportive of these green bond issuances from countries. I need to prefix what I'm about to say with that. They are very good developments, and certainly we were encouraging the Treasury to do so. as part of a much broader coalition of people who were engaging with them to encourage a green bond to be issued. But we need to green the entire bond market, not just issue a few green bonds and say we're job done. So it's kind of where have we got to? Something like 500 billion of green bonds now on an issuance. It's something like 23 trillion per annum. So it's greening the entire bond market that matters most. And that means the three credit rating agencies that matter, S&P, Fitch and Moody's, particularly S&P, that's 3/4 of the market. What are they doing to monitor TCFD implementation? What are they doing to monitor whether or not the individual securities that they're looking at are properly managing physical risk? There was a question that's come up in the Q&A about this. And I think that actually credit rating agencies, they're a licensed monopoly, or at least an oligopoly. And in return for that license to operate, they should be doing more to deliver on that. You also asked about what are our key concerns, the key kind of leverage points. And the question you asked around, do we need a policy or a price on carbon or a carbon tax? It's yes, we need all three of those. They can be brought together in one. We do need that. We need to make sure the cost of carbon is embedded in a corporate cost of capital. And you do that through standards and regulations. You do that through a market mechanisms like a emissions trading scheme or through the carbon tax. And it's only once the polluter pays that the cost of capital is actually reflecting the full cost to society. So governments, particularly the Treasury, issuing a green bond and thinking it's job done, it's not even beginning to be job done. They need to internalize externalities across every sector of the real economy using carbon pricing, fiscal measures, standards and regulations, and do it with vision and pace. We only just seen the first green finance strategy come out from the Treasury in the last few years. Honestly, 5 years ago, you talked about this, there would be no traction in the Treasury for it. And when we did the green finance strategy, and I was one of the advisors to the Treasury, we were told you have to not come up with fiscal measures. They're off the table. So now that we're going to revisit that green finance strategy, fiscal needs to be back on again. More to say, James, but there's more questions too, so I'll give it back to you.
Yeah, no, and very nicely put, Steve. Robert, I'm going to ask you now about investment portfolios and their managers playing a notable role in this transition. But what about banks, and how will we need to come alongside this transition in a way that adopts new lending policies in high carbon sectors? And what action have NatWest Group undertaken to reduce the emissions of its lending portfolio and also support its customers in making the transition?
Great, thanks, James. I'll answer it in a couple of ways, and the second half I'll probably build on something Steve was talking about there as well. I mean, for our own lending portfolios, I think as we touched on at the start in the video, you know, we are helping to end the most harmful activities, and we are committed to stop lending and underwriting major oil and gas producers unless they have a credible transition plan in line with the 2015 Paris Agreement by the end of the year. You know, the other piece there was in February last year, we set ourselves the challenge to halve the climate impact of our financing activity by 2030 and intend to do what's necessary to obviously hit that and align with the Paris Agreement. And finally, and it's linked into the financing targets we talked about. I mean, we talked about being one of the leading lenders to the UK renewable sector and helping our customers. And again, you know, February last year, we committed to delivering 20 billion of climate and sustainable funding and financing by 2022 and delivered 12 of that last year. So we've brought the target forward. And sitting where I sit in NatWest Markets, and you're aware of this, and Steve touched on it, there's still an awful long way to go in terms of green bonds and ESG bonds generally. But the pace at which this is accelerating has been truly unbelievable in the past 9 months. I think, you know, from the initial pandemic period when, you know, when governments and financial institutions and corporates came out of that initial period, the acceleration of using, you know, ESG frameworks in terms of financing is really accelerating. And we've seen it even more so in Q1 this year. And that's really great. And it's been great for us because, you know, we have a strong team in that space, but also plays entirely to the purpose of what we're trying to achieve. So lots more to do. I completely agree with Steve. You know, rating agencies and others need to play their part. But there is a real push now behind getting this, and you're starting to see the pricing differentials in the market, both in terms of the rates at which corporates and FIs can raise money, but also the size of the order books they will get as a result of having ESG bonds out there. So that, what's the economic benefit is now starting to kind of show through.
Great, thank you. So I've got a quick sort of last round of questions, and then we'll go on to some questions that are coming in from the audience. So David, a question to you. This is really all about data and transparency, these next three questions. The question to you is to allocate capital more effectively, you need better quality data, and you need to turn that data into information for decision making. How do you go about improving the quality of the data that you're making those decisions on?
Well, it's a critical question. And I'm going to answer it, but I'm going to also make another important point. So Jane alluded to it. There is a huge debate around the data that we're working with today and the consistency of approaches around portfolio alignment, for example. There's also similar questions that the TCFD is trying to address with corporate reporting around climate data, broadly speaking. And the truth of the matter is we're in early days of thinking about how the data really comes together. TCFD has been at it for 5+ years, but it's still very early days. But the point I want to make here is we're going to have to not let the perfect be the enemy of the good.
Yeah.
We will not have time to get to perfect. We're going to have to do the very best we can and just continue to iterate along the way. So data, we know that, for example, scope 3 is hard. So we've known scope 3 is hard for a long while. So our only choice is just to keep iterating, keep working at trying to make it better as we go forward, because that's the only way we're going to achieve our objectives of getting to 1.5 degrees C or less over the course of the next 10, 20 years. So data matters, but frankly, we're going to have to fly the plane and fix it at the same time.
Yeah. And Steve, what about creating common data and almost have data as a common good where it's publicly available? I mean, is that realistic? And what would you say to that?
It's really where we started. The Carbon Disclosure Project back in 2001, 2000. Yeah. That's where they started. And so a lot of companies do disclose their data, either via CDP or just to the market through their annual report and accounts. So anyone can see it. It's the analysis that I think is kind of more opaque. And it is interesting to me, it's almost an irony that the analysis of corporate transparency is itself not transparent.
Yeah.
So we need to actually produce some kind of free public league tables ranking corporate performance in this space. And it was that mindset that led us to help set up the World Benchmarking Alliance a few years ago. And they are already producing various league tables ranking corporate performance on the SDGs, and the goals 7 and 13 within the SDGs are all about climate, and they will be doing the ranking. And the analysis will be freely available for all. It's considered to be a public good. And it's not about how do the issues hit the company, it's how does the company hit the issue. So it is all about impact rather than, if you like, investment materiality. So I think there's a really important space for it, and it will need philanthropic and charitable funding. And we've done our bit. We've put £3 million in to the WBA to help set it fair for the future. I hope it's successful.
Yeah, no, and to you, Jane, what about? There's been a lot of talk in the media over the last few weeks about greenwashing and people making ESG claims but not really being committed to it. Do you think that how far away are we from having really good, transparent information that enables you to make good decisions about whether businesses are truly committed or they're just going through the motions?
Sure. I think it's important to think about both layers, actually, right? About the layer around corporate transparency and to carry on the comments Steve was making, we've also got the Science-Based Targets Initiative, of course, which is a critical input to many of the kind of temperature frameworks, which is supported by and helped created by CDP along with WRI and I think WWF for the three. So SBTI, of course, is a critical one. We've got the Transition Pathway Initiative as well. So we've got a number of different frameworks now that are helping to analyze the commitments that companies are making to allow us to better assess those commitments and see if they're below 2 degree aligned or not. And part of the phase we're moving into now is to develop a view on how credible those commitments are and what kind of weight we want to put behind them. So I think we're definitely seeing good progress in terms of those frameworks. And I think the best approach is to pull the best from each bit, and different asset managers may have different views on that. And it also, of course, depends on the kinds of assets we're investing in, the breakdown between public and private, which regions of the world, because of course, we don't have global consistency right now in terms of access to information with, SFDR and the non-financial disclosure framework in Europe, being relatively unique, which takes me to the second point, which is around, investor transparency. And SFDR, of course, has put a huge focus on all of us who are managing money in Europe for clients who now have better access to kind of an apples to apples framework to assess what are their asset managers doing or their prospective asset managers. And so I think that the focus from the regulatory side, along with, rapidly increasing sophistication by civil society. If you look at, groups like Share Action or Majority Action, looking at asset manager voting records, all of a sudden we've got a lot more information that can help the end saver, whose money it is, right, that we're managing, make better informed decisions about how they'd like to invest, who they'd like to bank with. Because we know that, people around the world are incredibly and increasingly concerned about climate change. And it's also, money from their pockets that we're managing. And I think it's a really important, transformation where we're really kind of empowering the end saver to put their money where their mouth is, from a broader perspective. So I think we're looking at both of the pressure, both on companies as well as, the investment chain.
Yeah, great. I mean, I think that's a really good way to look at it. So as we go towards, not only has this been a really insightful and brilliant panel with some very, very great observations around the challenges and the opportunities that we face, we've managed to get through it all reasonably quickly. So we do have some time for questions from the audience. And as we move towards that, I'd just like to ask each of the panel members what their views are for the outcome for COP26 and how we would expect that then to be a success. And perhaps I can start with you, Steve.
Thank you, James. There have been a couple of questions as well that I've seen come through that I'll try and address in my answer to. Yeah. So we've got Biden summit on the 22nd of April. We've then got the June G7 in Cornwall. We've then got a July G20 finance track in Venice. Then in Rome in October, we've got a G20 heads of state. And then we've got in November, nearly 200 days away, the actual COP26. We will know if COP26 is going to be successful on climate finance before COP26. And we need to look at what is Biden saying, what do they achieve at the G7 and the G20. And the most important piece, otherwise we're going to get lost in the 100 billion commitment that's about aid if we don't deal with the financial architecture of markets. The international financial architecture, the OECD, the FSB, the International Organization for Security Commissioners, the accounting standards community, all of them also have a role. Just as you said in the introduction, we all have a part to play. And at the moment, I think I've seen least progress historically in reshaping IMF, World Bank, International Financial Corporation, and the OECD, and ensuring that they're fit for the challenge that David set out. How do we mobilize the 2 to 3 trillion a year? Now, the OECD was originally created to deliver the Marshall Plan, reconstructing Europe. Yeah, that's done. What is its role here now? And could it now help finance developing country capital, or how could it help source private finance so that it flows into emerging markets proactively in a concerted attempt? Because 2 to 3 trillion I mean, what's that? It's 10 times the Apollo program and the Marshall program each year in current prices. It's an enormous amount of money, but it's deliverable. So that's my long answer to you. Sorry, James. The international finance architecture.
Yeah, and I think, it's interesting. Kristalina Georgieva, the IMF, is making this a real priority. It was a priority for her when she was at the World Bank, which was my boss. And her actions, I think, can lead to quite a significant progress. But let's hope that we can build that rhythm towards the COP that will give us success in Glasgow. Same question to you, Jane. What do you think a good outcome from the COP will be?
Well, look, if we want to be really simple about it, we need as many countries as possible, but, hopefully the big emitters to, deliver enhanced NDCs that align with net zero commitments. That's what we need to see, right? And that's what we should be advocating for. I think another less discussed but important element is around kind of Article 6 and carbon markets. And, I think getting a little bit more clarity around that so that we can develop a market which is credible and has the right structure in place.
Great. And David, to you, what are you hoping to get out of COP?
I think, well, first of all, Steve and Jane's points are terrific and critically important in many ways will drive success, but maybe closer to home for all of us. The question is, how will we as capital markets professionals take our commitments and turn them into action? I think we will have a very successful commitment to net zero COP. I believe that the capital markets, broadly speaking, whether it be asset managers, asset owners, banks, insurance companies, will quite dramatically commit to net zero. Actually, the asset manager net zero asset manager initiative today announced an incremental $22 trillion. So a third of capital markets is now covered in 6 months. A banking initiative will be announced. So we'll have plenty of people making commitments. What we'll be most interested in is transitioning from commitments to plans to action. Because not kidding, the next 5 to 10 years will be critical. And if we just congratulate ourselves in Glasgow and say, great, well done, everybody has made a commitment, and don't realize that commitments really are far from action, then we're going to be in trouble. So for us, it's really around what actions will we take to achieve our commitments.
So Robert, back to you to close us off on what's been a really, really outstanding discussion. I'm very grateful for our three panelists for their tremendous wisdom and insights. But back to you, Robert.
Thank you, James. And for me, and I'm sure on behalf of everybody who dialed in, thank you, Jane, David, and Steve, for spending your time with us. It's really, I've certainly taken a lot away from it in terms of my understanding of what are complex topics, but realizing that we can all play a part in driving forward real change in this space. Also, thanks to James for moderating, and thanks for everybody for joining. I think it was an indication of just how good everyone expected this panel to be, given the number of people who signed up. So it's fantastic. This is the first in a series of events on the road to COP26, and we'll be running more. So hopefully see you again soon. Thank you very much.